Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. GameStop had some pretty good news today. More important and surprising than their earning reports was the announcement of a partnership between the video game retailer and the cryptocurrency exchange FTX. This is another important move by GameStop that shows their commitment to their strategy to shift to non-fungible tokens. Earnings were mixed, with net sales falling 4% to $1.14 billion in the 3 months ending in July 30th. Analysts were forecasting net sales to be $1.28 billion. The loss per share was 36 cents compared with the average estimate of 34 cents. GameStop said it will collaborate with FTX on new e-commerce and online marketing initiatives, and announced they will begin carrying FTX gift cards in select stores. Though the financial terms of this partnership were not publicly disclosed, GameStop enjoyed a nice little run in the aftermarket, running about 13%. But to me, the most important announcement in this earnings was that GameStop disclosed that as of July 30th 71.3 million shares of their Class A common stock were directly registered with their transfer agent. The previous reported DRS count was around 590.8 million registered shares. This was really bullish to see, as I believe registering shares in ComputerShare will significantly help the price become more volatile as the shares cannot be manipulated by corrupt brokerage firms. So overall, there was no growth in sales, which sucks, but if you have common sense, you would know as the video game marketplace shifts more towards digital downloads. The good news is that we did see reductions in costs compared to the second quarter of last year. As of right now, they have $900 million in cash with zero debt and around $765 million in inventory as well. What this tells me is that GameStop is relatively strong, will be able to stick around for way longer than the corporate media would like for you to believe. I think the company would make great strides if it grows its e-commerce selling PC parts and other gaming-related equipment. We know crypto markets have been getting slammed and that their NFT marketplace has suffered greatly because of it. We will see how things develop, but one thing is clear right now, GameStop isn't going anywhere. They beat EPS by 8% and that's amazing. For us investing in this company for the technicality of a squeeze, the DRS number of shares was extremely bullish, and as hedge funds and banks continue to sink it, the quicker we will own the float. Will be interesting how the media twists all these things into a negative. Obviously, it's nothing to brag about if you aren't here for MOAS, but it certainly is not even close to being evidence of bankruptcy as the corporate media shills on a daily basis. I'm not leaving and I'm never going to sell. I will rather die holding my investment to my grave than ever pressing that sell button and having to live knowing I paper-handed on this. Now, let's talk about economics, because yesterday I promised you big content related to China and we have some pretty important events to discuss. When we think of China, we think about their exportation, because everything is made in China. Their means of productivity have been the engine that has elevated their economy to be what it is today. So we must wonder, what exactly happens when exportation begins to sputter and decay in China? Well, you get exactly where we are today, because reports show that their exports significantly missed expectations in August. The country's trade surplus began to shrink as the demand overseas flattened. Exports only rose 7.1% last month compared with the same period last year, which is almost half of the consensus expectations, which were set at 13% increase and down from the 18% growth in July. China's trade balance was expected to be $92.7 billion after reaching a record high of $101.3 billion in July, but only came in at $79.4 billion, a drastic change. Looking through other economic indicators of Chinese performance demonstrate that their trades are being hammered by a serious liquidity crisis in their property sector, which is nothing surprising as we have covered this in great detail since last year. We know that China is also going through great lengths to enforce widespread lockdowns with their zero-tolerance strategy to let any pandemic unleash again. And these significant changes in the Chinese economy lead us to one clear assessment: China is now believed to in the beginning states of the end of their export boom. Demand is down and the shipping prices have been in freefall. Production in the world's second-largest economy has been affected by the new rounds of city lockdowns, and the world has been looking for alternative markets to replace China, and they are finding them, which means the business that kept China's lifeline afloat is now being challenged in ways that may make it regress. The world could very well indeed become much less depends on the exportation of China, and that will have immense immeasurable effects in all global economies. As I have cautioned, it is not that things change that make markets unease, but the rapidness, frequency and shocking factors that do. Investors as of right now are aware of the changing circumstances, which is also why people are withholding from buying. But once full realization is made and the lack of liquidity in general markets cannot be dealt with, that's when panic will erupt and take over and we see the price of pretty much everything fall. China's changes are so radical that their imports only rose by 0.3% on year, below the expectations for 1.1% growth. These pricing changes and effects will trade performance in all sectors of Chinese economy. China's import growth turned negative since late in the first quarter of this year, which for some reason was greatly underreported in the financial corporate media news. Analysts are warning that Chinese exports are also expected to continue softening further as the prospects of a huge global recession looms closer in the horizon. With other economies reopened, consumption patterns are shifting from goods to services as well. With higher inflation and tighter financial conditions, foreign demand and dependency on Chinese goods will fall. This isn't even a question, this is a prognosis of things that will happen regardless of what China wants to do about it. The card that I think China is low-key playing is trying to get their tech sector to be as competitive to their American competition as possible. I think the rise in social media apps like TikTok are no coincidence, but rather elaborate attempts, successful by the way, by China to compete in service-like products and slowly transition away from producing goods. Looking at how well China emphasizes technology in their schools, it is very likely that they too know the transition that is going to happen and are preparing their population from childhood to be competitive in a world where digital markets and sold services will be more valued than manufactured goods. China is facing a dilemma. It's almost impossible to find a balance at the moment, and things are way more likely to fall apart before coming back to perfect balance through restoration of the economy. So I know many of you will ask, but who then will produce the goods that China will not be able to produce anymore? The answer lies right next to them in India. India is making headway in exports market, breaking into the top 56 suppliers of Christmas decorative items and T-shirts to the United States. Seaborne shipments of accessories in good in festival categories touched $20 million last month. India gained a clear lead over the Philippines as well. Though China exports a significant share Christmas decoration, many first-time buyers are approaching Indian manufacturers more now. If this isn't convincing enough, keep this in mind. Due to India having way more friendlier alliances and relationships with Western countries, the shift to moving factories of production there makes way more sense than keeping them in a country where hostilities seem to grow by the day. The Indian government says the country's economy remains on track to grow 7% or more this year, which is more than double the projections for global growth. India was affected by global headwinds, but their process to recovery is strong and continues to strengthen by the month. Do not ignore the fact that India's economy supports 1.4 billion people and is on track to pass China as the world's most populous. Even Facebook, now known as Meta, recently bought a $5.7 billion stake in India's biggest telecom operator. This is a big deal, because even big money is acknowledging the changes happening and are moving ahead of everyone else to ensure vast profitability long term. Lastly, bringing the topic of discussion back to the States, Bank of America is facing off a huge court battle with bond insurer Ambar Financial Group in a $2.7 billion case. It is one of the last legal hangovers from the subprime crisis that happened in 2008. Countrywide Financial, which Bank of America bought amid the mortgage lender's collapse in 2008, was the worst of the worst in underwriting securities, backed by bad loans in the years leading up to the crisis. The insurer AMBA is seeking to recover billions of dollars it paid out on those bonds. Countrywide Financial didn't care about the quality of mortgage loans they made because it was passing the risk on to others, which explains why Bank of America was interested in buying them. Now seeking financial resolution from America's worst bank, since they bought them out, the case is apparently intensifying in court. Bank of America has already paid out more than $50 billion to resolve regulatory probes, not that this is any remedy as they too got a good chunk of taxpayer money since the United States government believes evil corrupt corporations should be too big to fail, so in another word, you and your neighbors have paid more than $50 billion to resolve regulatory probes and litigation costs. This has nothing to do with the economy directly, but I found it a bit enraging to see Bank of America being cheap and fighting in courts the restitutions they should just simply pay for buying a company that intently wrote bad mortgage loans. Sad to see that we aren't even done correcting the transgressions of the past in 2008 and we are already nearing the next big economic decline brought to us in part by these same institutions with the help of the Fed. All in all, today's stocks climbed. Like I said, A bear market has tons of bull rallies, so I am sure this bounce will be short-lived. For now, enjoy a bit of the green you see in your stocks, but don't let it get to you. Hurry up and join my Discord already. We have tons of content and discussions happening there. Hope to see you guys there this evening. With all that said, thank you for making it to the end. I hope to see you guys on the next one. Enjoy the rest of your day and to the moon.